Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Vertiv stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 34 billion market cap. They're trading at $91 a share and they have 370 million shares outstanding. This company is a SPAC. It started out as a special purpose acquisition company. That means it was a private company, then they were acquired by a public shell company to become public. Vertiv designs, manufactures, and services digital infrastructure technologies for data centers, communication networks, and commercial industrial environments in the US, Asia Pacific, Europe, the Middle East, and Africa. Let's peruse their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a positive in 2021, but then a negative in 2022. But they do have positive net income, so it looks like they're investing a lot into CapEx. And that investment paid off, nearly $800 million in 2023, over $850 million in the trailing 12 months. Margins are improving at 12%. That means they convert 12% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was pretty low in 21 and 22. Then it blew up to $460 million in 2023. Came down to $400 million in the trailing 12 months. Margins are a bit low, 6%. Net profit margin is net income divided by revenue. Revenue is a sales for the company, and that has a nice upward trend from $5 billion to $5.7 billion to $6.9 billion to almost $7 billion. Revenue per share is $18.68. Each share price is $91. They do pay a really small dividend, not as small as Nvidia, but it's really small, 0.11%. It only cost them $37 million to pay the dividend. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year 4, that's $30 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $26 billion. We divide that by 370 million shares. And we get a calculated stock price of $70. They're trading at $91, so they're trading at a 29% premium. It's a sell according to the model. But this stock has been real hot. The trend is your friend. So I don't see a reason it can't keep going up. But I think it will come down eventually. Like most stocks, you cannot grow past your free cash flows. And you can't really fall below your free cash flows. Things tend to settle in. But it could take a year, it could take 5 years to settle in. That's the hard part for us to figure out. There are 26 companies in the same industry as Vertiv, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. Who would have thought a SPAC is on top? Generally, SPACs do terrible. This is definitely the outlier. They spend $141 million of CapEx. These are the investments in property, plant, and equipment. Plug spends the most at $614 million. They're a bit leveraged. Their debt to equity ratio is 2.2. For every dollar of equity, they have $2.20 of debt. They pay a really low dividend, of course lower than the median average. They generate the most free cash flow out of anybody on this list. They're the biggest company in this industry. They're a little bigger than number 2 and 3 combined. According to their price multiples, they're really overvalued. They're trading at 84 times earnings and 40 times free cash flow. Their price of sales isn't too bad. They're trading at 5 times revenue, which means their market cap, $34 billion, is 5 times their revenue. 7 times 5 is 35. That's why they're not 5, they're 4.9. And they're not growing as much as the median average. Their 5-year annual revenue growth rate is only 6%. If you put $10,000 into this company when they started trading, you'd be the smartest guy in the room at $90,000 today. That's 800% return, a 45% annual return. You would have been down at one point, then up a lot, then down again. Not many people could hold out until it went back up. Whenever I'm up a lot, then down, I usually sell. And I can't think of a time the stock blew up, because generally I hold really long term, unless I totally lose faith in the company. And if I invested in this company, I may have lost faith, especially when it came down at this point. Let's take a look at their latest 10Q. This shows us the first quarter of 2024 versus the first quarter of 2023. This is their P&L, their income statement. I like to understand how a company generates revenue. You can see in the first quarter of last year it was 1.5 billion. It's up to 1.6 billion. So maybe a 7% growth, which is decent. They show us a breakdown by products and services. Products is up from 1.2 billion to 1.27 billion. Services is also up from 334 million to 368 million. Let's see if they give more detail on the revenue. There's only one different breakdown by location. 900 million in the Americas. So maybe about 60% of their revenue is in the Americas. And if you scroll up, you'll get a little more info right here. Americas includes products and services sold for applications within data center, communication networks, and commercial and industrial markets in North America and Latin America. They give a further breakdown on what products are and what services are. Products include AC and DC power management, thermal management, low-medium voltage switchgear, busway. Busway is just one of many ways to deliver power between electrical equipment. It transports energy and connects to electrical gear, such as switchgear, panel boards, and transformers. The other products they sell are integrated modular solutions, racks, rack power distribution, rack thermal systems, integrated solutions, and hardware for managing IT equipment. The services are preventative maintenance, acceptance testing, performance assessments, remote monitoring, training, spare parts, and critical digital infrastructure software. A way to try to value the company is to look up these terms and see the demand, the future demand for them. In Asia Pacific, 360 million of revenue. They talk about that right here. It includes products and services sold for applications within the data center, communication networks, and commercial and industrial markets throughout China, India, and Asia. And they sell similar products in this segment and the Americas. Europe, Middle East, and Africa, that looks like it went up the most, dollar-wise and percent-wise. It says the same thing in EMEA as it did in APAC. Their operating profit is 288 million, up quite a bit from last year. APAC operating margin is 10%, 30 over 360, actually 12%. It's even more in EMEA because 10% of 471 million is 47 million. So it's about 15%. Half of 470 is 235. 235 plus 470 is 705. Almost exactly 15%. And their operating margin is 20% in the Americas because 10% of 933 is 93. 20% is 186. So it's a little more than 20%. Let's go through this income statement because it gives percentages. Revenue is up 8%. Cost of revenue up 4.5%. That means their margins improved a lot. It went up 14%. When I say margin, I mean gross profit margin because their revenue went up more than their cost of revenue. So that's why their gross margins are inflated. And if you want even more info on revenue, it talks about it down here. Revenue up 118 million or 7.8%. The increase was higher sales volume offset by negative impacts from foreign currency of 5.6 million. Product sales increased 87 million. Services increased 31 million. And cost of revenue, all the expenses directly tied to generating the revenue, that was 1.1 billion. It looks like their gross margins are 30%. The way you calculate that, it's gross profit over revenue. Actually a little more than 30% because 30% would be about 490 million. So maybe like 35%, but it's definitely better than last year. And they talk about cost of revenue down here. The increase in cost of revenue was driven by the impact of higher volumes. Here's their gross margin right here. I said 35%, it's 34.6%. Last year, 32.6%. Then you have SG&A, 314 million. That's up 1.7%. SG&A is up 5.3 million. The increase was from payroll and professional services. Then you have restructuring, only 300,000. Last year was 13 million. So their operating profit went up 55% from 130 million to 202 million. Really nice improvement. Their interest expense, the interest they pay in their debt, went down from 47 million to 39 million. And they talk about it right here. The $8 million decrease is due to a $4 million decrease related to a revolving credit facility that's due in 2029. Last year they paid 37 million in taxes, but they actually have a net loss this year, a net loss of 6 million. That was from the change in value of warrant liabilities. That was a $177 million expense. so it makes their net income look negative. But we'll see this expense added back on the statement of cash flows as a non-cash item. If you want to know what this represents, you can just go down a little bit. They talk about it. Here, it's right here. The change is the mark-to-market fair value adjustment of their outstanding warrants. Warrants are long-dated options. So when the company gives an investor a warrant, that gives the investor the right to buy stock in a company if the stock price hits a certain point. So they don't have to exercise the warrant option, only if they want to. And this resulted in a loss of $177 million in this quarter. Since the stock price is going up so much, the people that hold the warrant will exercise it, which will dilute the shareholders. Here's their full income statement. I just want to show you shares outstanding. Last year was 378 million. Now it's 379 million, so it's up a little bit. But their diluted shares are down from 382 million to 379 million because anybody that had dilutable shares converted their debt to equity. They took advantage of the higher stock price and exercised their option. I don't know exactly what the diluted shares are, but an example are convertible bonds. Let's look at the statement of cash flows. The first section is operating cash flow. That's how much cash a company generates from its operational business. So you can see they added back the warrant liabilities. That was a non-cash item. So they actually generated a lot more cash flow in this quarter compared to last year, even though they had negative net income, because the income statement shows their accounting profit or loss. It's not actual cash. So they're doing really well in terms of cash flow. They went up 200% from last year. In their investing section, they spent $35 million of CapEx. These are the investments in property, plant, and equipment. You could scroll down to the notes if you want to know what the CapEx spend is. The increased use of cash over the same period was driven by decreased proceeds from the sale of PP&E. That was $12.4 million. Increased CapEx of $8 million, offset by a decrease in investments of capitalized software of $1.3 million. And let's look at their financing section. They borrowed $190 million on a credit facility, and they paid down $190 million on a facility. They bought back a lot of stock, $600 million of stock buybacks. They didn't buy back any last year. They spent $9.3 million on dividends. Most of the return to investors is through stock buybacks. Very little is in dividends. Let's look at the stock on Simply Wall Street. Its last price, $91.36 billion market cap, up 4% in the past week. Look at this, up 300% in the past year. I wish I invested in this stock. It looks like they started trading in the beginning of 2020. And after just 1 or 2 months, it was down 50%. In a little over 3 years, the stock pretty much did nothing. It went up, then down, then back up. But it's pretty much flat. If you owned it from IPO, you may have lost patience and sold. But look how well the stock has done in the past year. At one point, it was over $100. It's come down a little since then, but still trading pretty close to its all-time high. Simply Wall Street is bullish on this one. Their valuation is 107. 13 analysts priced this stock at 102. Their revenue forecast for this year is $7.7 billion. Next year, 8.6. And then in 2026, 9.6. And the free cash flow forecast for this year is almost $900 million. Next year, over $1 billion. After that, $1.3 billion. So a lot of projected growth with the company. The red line is their debt. The blue line is their equity. So in 2018, they had negative equity. Their debt is still pretty high. It came down a little, then back up. But their equity has come up a lot. Debt of $3 billion, equity of $1.4 billion. And this green line is their cash. They have $300 million of cash on their balance sheet. The CEO's salary went from $600,000 to $865,000. Total compensation, $6 million. Tenure CEO, 1.4 years. In the past year, only insider selling, no buying. Platinum Equity sold 40 million shares in the mid to high 30s. I bet they're kicking themselves now. 83% of the company is owned by institutions, 14% by the general public, 2% by private companies, and 1% by insiders. Vanguard is the biggest shareholder, then Fidelity, BlackRock, Perpetual. They were probably involved in the SPAC. Geode, Norges Bank, Morgan Stanley, UBS, Trivest Advisors. and their employee count went from 20,000 to 27,000. The ticker trades on the Deutsche Börse, New York Stock Exchange, and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.